All right, guys, I am back again with another video. And in today's video, I want to take a chance to show you how to trade Ichimoku using order blocks. Now, I'm going to show you how to use actual order blocks with a platform called Quant Tower, and I'm using the power trades. So if you're interested in that, click the link below. I have a referral link for you. You can click that and learn it. But right now, I'm going to show you how to do it. And then I'm also going to break it down for you to show you how to do it if you don't have the platform, because not everyone's going to have this platform are going to want to even have that platform, but you have to still have a way to be able to find these order blocks. So I'm going to show you how to find these order blocks using the platform and using just candlesticks. And also, you don't have to trade using Ichimoku. You could trade this with nothing else on your chart, as pretty much I have done most of the time. And I'm going to show you at the end of the video here a link to another video that's going to show you how I've been profiting off of trading these order blocks. So I really want to get to this because I'm really excited to help you and show you how this could work for you. And I think it's something that you're going to like. So stay tuned. Here we go. Let's get right to this thing. All right, guys, before I get started, please make sure that you see my disclosure statement on the screen here and make sure that you read it and understand it. I want you to know for sure that I am not an investment advisor. Anything that I do and show you here today is for educational purposes. So if you decide to take it upon yourself to indulge in anything that I am teaching you today or showing you, please make sure that you consult with your own financial advisor so that they can help you to assess the relevant risk factors associated with trading futures, forex, stock market, or any type of market for that matter. All right, so please understand that. So then always before I get started, I really like to give you guys a word of encouragement. So today's word of encouragement comes from Isaiah 40, chapter 40, verse 8, which states, "The grass withers and the flowers fall, but the word of our God endures forever." People here are referred to as grass and flowers that wither away. We are mortal, but God's word is eternal and unfailing. As we grow older, our vital bodies we had as young people begin to decline. As we fade physically, we can see the enduring quality of God's word more clearly. This reminds us to count on Him for eternal life and not on our own strength and understanding. God's word remains constant. Only in God's eternal word will we find hope, comfort, joy, peace, everlasting love, and eternal security. God bless. Amen. All right, guys. So we said we were going to talk about order blocks. So we're going to talk about order blocks. So let's get with this order block discussion here. So basically, order blocks are the sale or purchase of large number of transactions, generally broken up into smaller orders, which are then called iceberg orders. So what we're going to be looking for are the iceberg orders, because that one big, huge order is not going to be put into the market all at once, because it will alert everybody. It'll move the market. It'll do all kinds of things. And they really don't want to do that. And to top it off, these are native iceberg orders, because most orders aren't going to even be seen because they're not even processed the same way that we're processing things. All right. So there's a bigger story to that, and it's a little bit different, but we can see some of these big orders come in. So we're going to use this iceberg orders. We're going to see these iceberg orders, and we're going to use those as our order blocks. Okay. What happens is basically when a big order comes in, it gets filled at a level. And a lot of times that level is a level where they're looking to add more to that trade. So they may only put about a third or maybe a quarter of the trade in at that point. And they know they want to get more of the trade in. So they're going to probably wait, or more likely wait for that level to come back to where they want to put more into the market. That's what we're going to take advantage of, because where we see them put that first order in, we're going to use that as a zone, and then we're going to trade that zone when the market comes back to that level. All right, so we're going to use that to our advantage. So why should we identify order blocks? Basically, we should identify order blocks because it helps us to spot the smart money, which is the institutional investors. Okay, so you want to be following the institutional investors, the smart money, not the retail money. I'm sorry to say, retail traders, we are not the bombs. The ones that are the main people to be following are the institutional traders. They have more insight to everything. They understand the markets more, and they have more tools and more things at their disposal, as well as capital and so forth. All right, so therefore they're able to move the markets a little more than we can. Matter of fact, move the markets more than we can because we don't barely move the market. All right, because we don't have enough finances to move the market. So therefore, these big institutional traders move the market. And we want to be able to identify the levels and the areas where they move the market. So how can we identify those levels? How can we find those levels? All right. So on most platforms, the ideal way of spotting these blocks is through the time and sales window. The time and sales window displays the timestamp for each trade along with the price and order size executed. So some platforms allow you to highlight trades on the time and sales that execute at or over a certain amount. And that's basically what we're going to do. We're going to have a set amount that we're going to be looking for on the one platform that we're using. So if you like what you see on this video, you like the platform I'm using, again, I told you, look down the description below and you'll see a link for this platform. And also you'll be able to use what I'm using to spot these order blocks. All right. So level 2, though, however, can be misleading. With level 2, traders can spoof, meaning they're going to put a big order in, and you're going to see that order sitting on the market, and you're going to be like, okay, this is where I'm getting into the market because I see these institutional traders getting in here because I see these big orders. And then boom, that order disappears. They spoofed you. You get into the market at that point, and then you get stopped out and wonder why. You're thinking like, oh, these big traders, he must have got stopped out too. No, they took the order off the table. They were just misleading you and misguiding you. It is against the law to really do that, but I guess they still do this kind of stuff. Another way to spot these orders is using the power trades that I'm going to be using, the power trade scanner from Quantower. So the power trade shows the zones with the execution of a large number of orders in a very short time. You will see that when we get to the chart. So here's your time in sales. The time in sales reveals the actual trades that have been executed at each price level. It reveals the truth in terms of the actual liquidity. Time in sales displays where large block orders occur, but the speed of times in sales is overwhelming for most traders. You will not be able to follow time in sales unless you've been doing that for years. You cannot just start today looking at time in sales and say, oh, I'm going to start following time in sales and looking for these big iceberg orders, these big block orders, and try to trade the market. It will not happen. You need years of training for that because it is a very fast moving market when you look at it that way. Okay, so that's one thing. You don't really want to be able to jump into time and sales and start doing that today. But what I'm showing you, you can start doing today. All right, so another way to observe these block orders would be with the scanner provided that I just said. All right, so in this case, like I said, I'm using the Quantower platform and the tool's called the power trades. It shows the zones with the execution of large number of orders in a very short time. Every red arrow is pointing to a zone that they have shown me in a very short time, and how much, like this right here shows these are all the zones on my right here. Okay. And it's showing all of these zones and how much was traded. Okay. So what you're going to be seeing is the delta. So the delta is a quick way to determine who's in control of the market through aggressive orders, buyers or sellers. Delta is the difference between the volume traded on the offer minus the volume traded on the bid in a particular bar or zone. So on one of these candlesticks, that's what you're going to be seeing. So each bar or zone will have a delta number. Delta will either be positive or negative, and sometime it could be 0, but not really. So here's your delta. All right. Your total volume. Then your basis ratio. So the basis ratio shows the ratio of the volume in the zone to the total volume for the specified time. All right. So there you could see that's what all this information gives you. Gives you the date, total volume, the delta, and the basis ratio. And then you can see them on your chart. So these zones are true order block zones where iceberg orders have been placed. In this case, the zones are not based on candles, but actual volume and cumulative delta to show the strength of the zone. The arrows under the levels show where price bounced on the levels, and the area between the two levels is an imbalance. The last major move shows price coming back to the lower order block. All right, right here came back to the lower order block, and then a huge move away from the level. Again, this is not devised from candlestick patterns, but rather through depth of market and market analysis. So basically, you could see these zones. A zone was created here. So what I do when this candle creates this order and it makes a block around the candle, I extend the zone. Then I do the same thing here where I extended the zone. The reason I extend the zone is because the thinking is if they placed an order here, they didn't put their full order in. So when price comes back near this area or to this level, they're going to want to put more into the market, and then I'm going to jump in also. Now I just trade these levels. Now same thing here. So they put more in here. So maybe they put some here, they put some here, they could have put some here, or someone else put it there. But at this point, when you see it, you draw your zone and then you take the trades. You bounce and take those trades. All right, so this is again showing you the order blocks. This is showing the time that the order block was printed. So this is the order block that was printed right here. This blue one. Now here's another order block, a yellow block, but this is the one that is showing right here. And it's showing that it's 162. So again, I'm showing on the Dow, all right, and I'm showing that 162 volume, 76.54 delta, and 8.28 ratio, basis ratio. So now I move down, and you can see this zone now that we're showing. So we were showing this one, now we're showing this zone. And again, it's showing the amount. And again, you can see I'm using the Dow here, but I want to let you see and know that it's not only for the Dow, not only for futures, not only for actually this doesn't work for forex, but it does work for every other thing, for cryptos, stocks, and futures. Okay. So here's an actual trade that I took. You're going to see me actually, I'll bring this up for you. And also you could look on, at the end of this video, there will be a link to 2 other videos that will show you some trades that I've taken with the order blocks, and you can see how it works out. But here's some zones. Here's a zone here. Looks like it wasn't honored any time after it was placed in here. Here's a zone here. And I love this zone because it's at the top. So when the market comes back to this level, it's a high point. And I like to see the market come back to that high point, because a lot of times then the market does go back to the downside. Then here's another zone here. It looked like it was honored once and then dropped, and then it didn't really drop that much. Here's another zone here. So I'm going to take a trade at this zone. You're going to see me extend the zone, and then you're going to see that I take the trade and I extend this zone on the bottom, and I'm expecting this market to go from this zone back down to this zone. So let me show you exactly what I did. Here you can see I extended the zones, extended that zone. Now the market hit right here previously, didn't reach there, then came down, created this zone, and then just touched this level. Now you can see where I got into, where my entry is right here, and here's my stop loss right here. All right, and I was in the market with 5 contracts. We're trading the NASDAQ 100, E-mini NASDAQ 100, and you could see what I made for profit, 22.25. All right, so we bounced right off of that level, and then the market dropped to the downside. Was able to make some profit. Just trading the order block. I put my order in prior to price getting there, well, just before price got there. But when price is down here, I already can have my order set. And I can also have my stop loss set. You know exactly how much you're going to lose if the trade doesn't work for you. So you already have your risk management set up. So if the zone is too big for you, it's over your allotted capital loss. All right, over your risk reward, over your risk management, then you don't take that trade. So therefore, if I'm looking at this trade and I say, okay, 10 ticks, it's over my target. my loss I want to have is like 10 ticks. So the most I want to lose is 10 ticks, let's say. But this zone, let's say this zone was 14 ticks, then that means you don't take the trade. So you're going to have to base all that on the amount that per tick and so forth. You're going to have to figure that out on your own. I can't figure that out for you right now. You'll be able to figure that out. That's how it's going to be part of your risk management. All right. And you want to always do that. If you cannot afford a zone, do not trade the zone. All right. So another thing that you could do, if it comes to the level and this zone is too big for you, you can wait to see if the market pulls deeper into the zone, and then that will eliminate some of the risk that you're going to take. And then at that point, if it reaches, so let's say this zone right here is where I entered is, let's say it's 10, stop loss would be 10 ticks, let's say. But let's say you couldn't afford that. You could only afford 5, and I'm just giving you numbers. So if you could only afford 5, then let's say you put your entry in the middle. All right. And then you get triggered into the trade. If it doesn't reach the middle and just drops, then you're not in the trade. You don't lose anything, and you're not over your risk management. All right. But if so, you still have an opportunity to get into the trade. You don't automatically have to say, well, the zone's too big. You just cut the zone in half to make it fit your risk reward. And if it comes to that level, then you're able to trade. So zones, I said, figure you shouldn't be able to have to eliminate a zone just because it's too big. You should be able to cut it in half and then make it the level that the amount that can fit your risk management. And that way you can still have an opportunity to take the trade if it does happen. All right, like this pierced in a little bit, so it would have cut a little bit of the reward of the risk off. And this here, a lot of times this is what happens. Okay, it comes right to the level and then drops. All right, so that's what you could do. You got to definitely make sure you're taking care of your risk management, because you want to be winning a larger amount than you're losing. So here's the order block, and you could see this order block was created. Here's the date it was created, how much was used. So here we were using the NASDAQ. Now we're using the S&P 500 on this one. I'm using a 2-minute chart. I use a 2000 tick chart. I use a 5-minute chart. You can do this on an hourly chart, 4-hour chart. I seem to be the daily is a little tougher because it makes a whole bunch of zones in one candle. So I probably have to up the number, and I'll show you what I'm talking about in a little bit. But here you could see this is the zone, where it was created, what time, actually how much volume it was, the delta and the basis ratio. So the zone was created, the market moved higher. Actually, the market moved higher, came back right here, touched it and moved higher again. Then came back into the zone and then moved higher. So here's what I was talking about, exactly what I was talking about. So let's say this zone is, I can't really see what it is. It's about 4602 to 4605, about that, somewhere in there. So let's say it's 3 points, right? So 15 ticks. 12 ticks, right? So if it's 12 ticks, let's say you can only afford 8 ticks. So this would be 12 ticks, right? So you instead of putting your entry right here, then you could put your entry at the 8 tick level. If the market comes up and down to your level, you're in the trade. But if the market comes up, doesn't come down to your level and goes, then you just don't lose anything. So you don't have to say this zone is too big. You just put it at the level that you can afford. And if you can afford more, then you can play the whole zone. Now, a lot of times what I'll do, so a lot of times these order blocks, the market comes right to it a lot of times and then goes. So I usually have a resting order at the level, 1 tick above it. But sometime, if I don't have an entry at that point, I will wait for the market to come into the zone, and then I'll walk the zone. What I call walking the zone is the lower the price goes down, the lower my entry moves. So here I would put my order there. If the market goes all the way to the bottom, then I will put my order halfway. All right, so I walk that zone down. I eliminate this much risk, and I now only have this much risk. All right, and so therefore I can afford the trade if it's going to come into the zone deep enough for me. If not, I don't lose out and I just wait for another trade. All right, so that's how you look at that. So here's another order block. I really want to show you, this block was created here. And you can see where it is right here. This is the time, and 2:30. We're back on the Dow again. 68.7 delta and 1233 basis ratio. So look what happened here. We created the block, the order block, and so we extend the zone. The market came in, hit one time, hit twice, hit a third time, dropped each time, moved up higher later, touched the level, just touched it and dropped. So that's the case where it just touches and drops. But here's a case where it goes deeper. If you couldn't afford the zone here, you definitely can afford it here now. And then it drops again. Here it comes into the zone. It sucks up everything, drops back to the downside this time. So this time it breaks the zone, comes back, and now this zone is more like a demand level, and then the market moves higher. Here it was more like a supply level, and the market dropped. All right, so this is great trading. A little bit of risk here, and it just works really well. So let me show you the power of one order block. All right, this order block was created just like I showed you on the last one, but here it is right here. And we're using S&P 500 again this time. You can see what we have in here again. So we extend the block. Then this time the block said 1 time, 2 times, 3 times, 4 times, 5 times, 6 times, 7 times, 8 times, 9, 10, 11. Then in here it broke, and then it was now supply at this point. Now then it broke this level. Again, it hit this level and dropped, and then it broke through the level. So it hit the level, dropped all the way down to here, made this low, and then broke the level, and then came right back to the level, and then moved higher. Very powerful. All right. So this time we're using BTC USD. We're still trading like a 2-minute time frame. Could do a 5-minute time frame. We're doing a 2-minute time frame on here. But you can see the block was created. Then you just patiently wait. The block market came to the block, hit it again a little bit, came here and hit twice and then dropped. You make profit on these moves here. BTC USD. So not just for futures, but also for crypto and also for stocks. Now, in this case, you could see this order block was created. Now, this is how I want to show you how you can work this concept with Ichimoku. So basically, here's the level, the zone. So it was created. We make a zone here. So we're above the cloud. Anything above the cloud, we're going to trade long. So we're looking to bounce off of the zones to the upsides. Anything below the cloud, we're going to look to bounce to the downside. All right, so we wouldn't trade short here. We would only trade long. So the zone was created. Market moved a little higher, then bounced once, bounced twice, and then took off. All right, so therefore you would have made profit bouncing off of this order block, trading the bias of Ichimoku. I don't really pay much attention to the crossover because I'm going to trade the bias all day long. And then the crossover is just going to be for the medium term, but longer term, I'm trading the bullish bias as long as the price is above the cloud. And in this case, you could see again, this block was created. This block was created right here. It's a big block, but the market pulled out of that block, almost touched it here, and then came inside the zone a little bit, moved a little higher, touched it, and then moved much higher. All right. And you're trading bullish order. You're trading to the upside just because price is above the cloud, and that's all you're really concerned with. All right. So in this case, the market's moving to the downside. Price is below the cloud. So price is below the Kumo cloud. At the cloud and right around the cloud was a block that was created, a double block on this one candle. So this is a pretty strong candle. And then you could see I made a zone and extended the zone just to show you. And you could see these two candles, these two, this block here showed the two order blocks right here, or the two orders. And then the market pulled up to this level and then dropped. All right, you had a good trade. And we're using S&P 500 in this case. So here again, Ichimoku were below the cloud. So the market's below Ichimoku's cloud, the cloud. And you could see we had an order block created here. So we've been looking for a short opportunity. The market pulls up to that block and then drops. In the process, another block is created within this candle here. So when that block is created, the market pulls up to the block, creates another block, and then drops. All right. You could see the profit you could have linked into. All right. Here's another one. This is where a block was created and the market pulled into this block. And this one would have been like, you would have probably not thought it wasn't that going to be that good of a trade. But the market came out of the block and continued to move to the downside. You could see where the block was created and what it was on the block. All right, so now you're below the cloud here. All right, you create a block. This is a very thin block. All right, and I pretty much have the zone drawn a little bit bigger, but that you just really need to draw it on that zone. And I'm going to show you how precise this stuff is. But the market comes right back to that level pretty much and then drops. Gives you a good trade. Okay, then if you would have had a block here, you probably would have got a touch here and then the market moved higher. But you're trading the bias of Ichimoku. You're trading the bias of the cloud, so you would have been looking only for short trades at this point. All right. And again, I can't give you anything that works 100% of the time. That's why you have to learn to control your risk. But I think I can give you something that works a lot of times. Okay, so here again, we see we're below the cloud. So there's an order block within an order block. Because we're below the cloud, we're going to be looking for bearish order blocks, basically looking to go to the downside. So this created a block, and I didn't cover it. I didn't cover in the whole block, but because the block is down here, it goes from here to here. And then you could see the market drops, pulls into the block, drops, pulls in, creates another block, and then drops. All right. And then you would have had good profit on this trade. Once again, Ichimoku, we're above the cloud, so we want to trade bullish order blocks. So looking at this block right here, created over here, if you didn't have if you didn't know anything about these order blocks or didn't know what to do, how to trade a moving market here with Ichimoku, you probably maybe would have been able to catch the Kijinsen and bounce here. But if you didn't know this, you see this block here, you trade the block, you're above the cloud, you trade long. You can see the market moved, a really nice move off of that block. So last one we're going to show you here is that this block right here created a nice zone, a very small zone. Look how thin that zone is. I didn't make it the whole candle. So just wanted to really show you how strong the concept is, because I drew this little zone. Then later the market just touched the zone. I mean, barely touched the zone and then dropped, gave you good profit. But the main thing about it also, you could see there was confluence here because we had a flat cloud that the zone was sitting on, and the market came, just touched the level. You should have been in that trade to the downside. You'd have been good to go. Now, if you only just trade the bias of the market based off of we're bearish because we're below the cloud, we're bullish because we're above the cloud, you would take this trade. But if you start to look at, oh, we got a bullish crossover, Chiku span is doing this and so forth, you're not going to take that trade. All right, because at this point, it seems like the market may be changing. All right, and then you're not going to take the trade, and then the trade goes to your favor, but you don't take it, so you miss out. Again, Ichimoku's not as fast as the market, okay? So I have this scanning tool, and I pretty much use that. But prior to having the scanning tool, I used just the charts. I just used the candlesticks to show me this. So I'm going to show you the candlestick order block formation that I would like to just help you to understand and learn. So I'm only going to show you one order block formation, a bullish and bearish concept. So here we are. This is a bullish order block. And basically, we all know what this candle is. We all know this is a bullish engulfing, right? So you're going to look for bullish engulfing candlesticks, and that's going to be your zone. So let me show you. Let me go to the next slide here. What I'm trying to show you right here is, in reality, you can see where a block trade was really created right here. All right, because we have a bullish engulfing, and you could see there was a block right here that was made from the software. The software created this zone. So therefore, the bullish engulfing formation was acceptable and did create a true zone that we could have drawn. If we didn't have this tool, we would have just drawn the block like this and extended it and made that the block and look for the market to move higher and come back to the block, and then we trade. Okay, that's what we would have looked for. So let's move to the next. So I'm showing you right now that this bullish engulfing, there was an order block created here. This yellow box is the true order block, just like these are here. So that order block was created. So therefore, if we are using the bullish engulfing, not all the time is it going to be a true order block, but we can summarize it as an order block area, because when you see this, a lot of times it is going to be a place where the market moves away from that level. So we summarize that there's a lot of volume here, and we think that this is an order block because there would be a lot of volume to move the market. Sometimes that's not the true case, but you could see what happens really. So if we were using Ichimoku, all right, so let's go back real quick. This is that order block, and so let's go to the next one. This is a bullish engulfing order block. If we're using Ichimoku, now we don't have the scanner, so we just look for these types of candlestick patterns, the bullish engulfing. Therefore, we have a bullish engulfing here. The market moved higher, came back to the level, to the zone, then moved higher, came back to the zone again, touched it again, and then moved higher. So trading with Ichimoku, we're trading long above the cloud. All right. Here again is another order block created just from a bullish engulfing right here. So you could see this bullish engulfing. There was one here, so I marked a line, but the market never came back to that level. So I put this one here. There was another one here, but I put this level here, and you could see even if I would have put this one, it would have been pretty much lined up with this one over here. But the market did pull back, touched the level twice, moved higher, came back, touched it again, and moved higher. So we're trading the bias of Ichimoku. We're bullish, so we trade to the upside. Very nice trade. And then finally, you could see another order block created here with a bullish engulfing. The market came back, touched the level, and moved higher. Came back, and I don't know what it did over here, so I don't have the full thing. But it didn't make this block come back, touch the level, and then move higher. You would have made a good trade. Ichimoku, you're above the cloud, so you look for that long opportunity. Okay? So finally, we're going to also look for the bearish engulfing pattern for an order block. So let me show you what an actual order block would really look like. So here's a bearish engulfing, and then within this bearish engulfing, you can see actual order blocks were created with the scanner that we're using. But if you didn't have the scanner, you would just mark this as an order block, and you would fill in your zone, and you would pretty much extend it like this. Market drops, then it comes back to your zone. And then you trade, and then you make $2 million profit. Okay. And then you thank me for showing you this strategy. And then you give me half of that million, right? Or half of that 2 million. No, not for real. I wouldn't even want it. All right. I would just be happy for you, but I don't think you're going to make 2 million on the deal. Let me close this. But I'd be glad to see somebody making that kind of money. Hopefully this kind of stuff really helps you to make money. You don't have to be making that type of money, but hopefully it's something that helps you to be consistent, helps you to be able to control your risk and so forth. All right. So now, here's a bearish engulfing order block. But what I'm showing you is that this block right here was created right here on a bearish engulfing candle. And you can see the market came right back to that zone. All right, because I didn't draw this zone in. So I'll show you on the next one that the market does come back to this zone. All right, I always get ahead of myself, but that's the same zone. Just want you to see that it was actually really drawn here. Now, if we didn't have the scanner, we would just mark this as a zone. We would pretty much do this, and we wouldn't have this marked, and we would see the market came there, and we would have had our trade. All right, and this is trading without Ichimoku. We're just trading the direction of the market. So you could put a moving average on here. You could put anything that's showing you directional bias, or else just trade the regular price action direction based off of the structure of the market, and you can just catch these blocks and trade the direction. All right. So here again is a bullish order block. You could see this bullish engulfing candle. Made a small block here. The market dropped a little bit and came back, touched the zone, and then dropped. This is an actual zone that was created with the platform. So the main point I'm trying to get across to you is that we see actual block trades developing at the bullish and bearish engulfing patterns. These yellow boxes are actually where there were large orders placed. All right, so we can have confidence knowing that the bullish and bearish engulfing pattern is a possible level where block trades were created or are developed. It's a possible level, so we're going to use it as always a level. All right, but there's a way to summarize and understand which levels are stronger, and I like levels more so when they're at highs and lows. Okay. So here's one that we didn't have an actual block on it. Now the market didn't come back to this one, but then here's where we did have an actual block. I mean, we didn't have an actual block. We created our own block based off of the bearish engulfing. The market was bearish because we're below the cloud, so we're trading short. The market comes up, touches, and then it drops. So we had that trade based off of the bearish engulfing. And here we're trading crypto market, SOL USD, SOL USD. All right, so therefore, I'm showing you it works with all assets. So here again, you can see we're still trading with crypto market. You can see the order block was created, and then the market comes right to that block, and then the market drops. We will make profit just trading these order blocks. Now here you can see bearish, the market's bearish. We're below the cloud, so we're going to look for short trades. A block was created here, and then another block was created here. The market touched the block, drop, touched the block, drop, touched the block, drop. You would have had a couple good trades, and this is crypto on a 2-minute time frame. Now this block that was above us previously, on the last one, you could see this is what you get. The market came back up to this level that we said it wasn't at. We got bounces here, and then the market came up to this level. Now, in the case of trading with Ichimoku, you wouldn't have taken this short because now you're above the cloud. But you could see, if you were trading with nothing on your chart and just traded these order blocks, you would have taken a short there. You would have taken a short there. All right. So that's what you got here. So I don't show you guys things that that I like to just draw up stuff and say, hey, this works and try this or do this or that. There has to be some reason why, or something that I'm doing, or something that's proven. Okay. So you can look on my site on YouTube and see that I have a couple trades using these order blocks where I showed you, and I made a couple $1,000s on some of these trades. So on the video here at the end, you could just click on the link and go to the videos that I'm showing you where I made some profit trading these blocks. But I just wanted to show this to you guys and wanted to let you see that it's a powerful concept. So a couple things you can understand now. Understand how to create an order block without having any software. But if you really want to get the software and see the real zones created, and also learn how to trade these zones while they're happening also, so you can jump on the trade as it happens. There's other ways to learn that and do that based off of what we see on the scanner. So if you really like that, click the link below where I'm referencing the Quant Tower platform, Power Trades, my referral link. And if you like it, then maybe you can use it to your advantage. All right. But this is what I wanted to show you guys today. Hopefully this is something that helps you. And again, look at some of the trades that I put out on YouTube. The video right now showing you some of the trades that I did take. So again, not just showing you things out of thin air, showing you things that are true, actually happening, things that I actually do. All right. So guys, I hope you enjoyed that. And until next time, have a great one. God bless. So long.